Something just happened in the silver market that most people are completely ignoring, and if you've been watching silver for any length of time, you already know that silver doesn't move to $86 for no reason. It just doesn't do that. When you see a number like that, a number that hasn't been touched in decades, you have to stop and ask yourself, what changed? What broke? Because something always breaks before a move like this. And today, I want to walk you through exactly what that something is, why it matters more than the headline price, and why, if history is any guide, the story here is far from over. Let me set the scene for you. We are in 2026 now. The world has been watching a very tense diplomatic dance between the United States and Iran. There were talks, there were back-channel negotiations. There was this cautious, careful hope building in the markets that maybe, just maybe, a deal was coming. And that hope? It was doing something very specific to the silver market. It was suppressing it. When investors believe geopolitical tension is about to ease, they move out of hard assets and into riskier plays. They feel safer. They relax. And silver, which behaves partly as a safe haven metal and partly as an industrial powerhouse, tends to get sold off when the world feels calm. So here's what makes this moment so significant. Trump came out and called Iran's demands unacceptable. That word unacceptable isn't diplomatic language. That's a door slamming shut. The peace deal hope didn't fade. It didn't get postponed. It died. And the moment that happened, the suppression on silver lifted. And what happened next told us something incredibly important about where this market actually stands, underneath all the noise. Let's break this down from the very beginning, because there are really two silver markets happening at the same time, and most people only know about one of them. The first silver market is the one you see on your phone or your trading screen. It's the paper market. This is the world of futures contracts, derivatives, swaps, and options. When you look up silver price on any financial website, you're seeing the paper market price. Now here's the thing about the paper market. It's enormous. We're talking about contracts representing hundreds of millions of ounces of silver being traded every single day. But here's the catch. Most of that silver doesn't actually exist in a physical vault somewhere waiting to be delivered. Most of those contracts are never settled with real physical metal. They're settled in cash. Traders are essentially betting on the price of silver without ever needing to touch a single ounce of it. The second silver market is the physical market. This is the world of actual silver bars, coins, industrial stockpiles, and the real-world supply chain that feeds manufacturers, technology companies, solar panel makers, medical device producers, and defense contractors. The physical market is a completely different animal from the paper market. It runs on actual supply and actual demand. And here's where things get really interesting. For the past couple of years, the physical silver market has been running at a deficit. That means the world is consuming more physical silver than it is producing. Now, when I say consuming, I mean real, irreversible consumption. Silver goes into a solar panel, and that solar panel gets installed on a roof. That silver is gone. It's not coming back. Silver goes into an electric vehicle, into a circuit board, into a military guidance system. It's locked up. Unlike gold, which mostly sits in vaults and gets recycled over and over again, a huge portion of the silver the world uses every year simply disappears into products. And the amount of silver going into those products has been growing fast, especially with the global push toward clean energy and advanced electronics. So you have a situation where physical demand is rising, physical supply is struggling to keep up, and the physical stockpiles that do exist are sitting in very specific trackable locations. The most important of those locations is the COMEX warehouse system in the United States. Think about COMEX as the central registry of silver that's available for delivery to big commercial buyers. When you see the COMEX registered inventory numbers, you're looking at the silver that's actually available right now to be handed over to someone who wants physical metal. And those numbers have been telling a very concerning story. The registered silver at COMEX has been shrinking, not just a little, significantly. What that means is the buffer between the paper market and the physical market is getting thinner. The cushion that allows the paper price and the physical price to stay somewhat connected is eroding. And when that cushion gets thin enough, something has to give. Now here's why the geopolitical piece matters so much. When the Iran peace deal was still alive, when the diplomatic hope was still in the air, big institutional money was rotating away from safe haven assets. They weren't as concerned. They weren't scrambling for protection. And that rotation was keeping artificial downward pressure on silver's paper price even as the physical market was screaming that something was wrong. The paper market and the physical market were drifting apart. The paper price was saying calm down, while the physical vaults were saying we're running low. Trump's rejection of Iran's demands collapsed that diplomatic hope in a single moment. And what followed was what traders call a catch-up move. The paper market, which had been held back by geopolitical optimism, suddenly had to reckon with the reality the physical market had been living in all along. The result was a spike to $86. But here's the thing, a catch-up move to a new reality isn't the end of the story. It's often just the beginning. Think about it this way. Imagine you're watching a rubber band being stretched. The physical market is one end, getting pulled further and further in one direction by real supply deficits and real rising demand. The paper market is the other end, being held in place by sentiment, by speculation, by diplomatic optimism. When the thing holding the paper end gets released, when the optimism collapses, the rubber band snaps. And $86 silver is what that snap looks like in the first moment. But the question you have to ask is, has the underlying tension in that rubber band actually been relieved? Or is the physical shortage still there, waiting to pull things further? Let me tell you what the COMEX data is actually showing right now, because this is the part that most financial commentators gloss over. The registered inventory, the silver actually available for delivery, is still at historically low levels relative to the open interest in silver futures contracts. Open interest is basically the number of outstanding promises to deliver or take delivery of silver. When you compare the open interest to the registered inventory, you get a ratio. And that ratio right now is stretched. It means a lot of paper promises are backed by a relatively small amount of real metal. Now, most of the time, that's fine. Most of the time, those contracts get settled in cash, and nobody asks for physical delivery. But here's what changes when the geopolitical environment gets hot. Industrial buyers who depend on silver, the manufacturers, the defense contractors, the technology companies, start getting nervous about their supply chains. They stop trusting that they'll be able to buy what they need on the open market when they need it, so they start securing physical supply in advance. They go to the COMEX and they say, "I want my silver now. Deliver it." And when enough of them do that at the same time, the gap between the paper price and the physical reality gets exposed very, very fast. This is called a physical squeeze. And the conditions for one are arguably more present right now than they have been at any point in the last several years. You have geopolitical tension re-escalating after a failed diplomatic effort. You have industrial demand for silver that's structurally growing, driven by the global energy transition. You have defense spending ramping up in multiple countries, and silver is a critical material for defense electronics. And you have COMEX registered inventories that are thin by historical standards. Now I want to pause here and be clear about something, because this channel is about helping you understand what's actually happening, not about getting you worked up or scared into making hasty decisions. None of what I'm describing is a guarantee that silver will keep going up. Markets are complex. They are influenced by 1,000 variables at once. There could be a surprise diplomatic breakthrough. There could be a demand slowdown if the economy hits turbulence. There could be new silver supply coming online that changes the equation. I'm not here to tell you exactly what silver is going to do. What I'm here to do is help you understand the forces at work so you can make your own informed judgments. And if you're finding this kind of breakdown useful, this is exactly the kind of analysis we do on this channel. If you haven't subscribed yet, hit that button now. And if this video is giving you a new way of looking at the silver market, drop a like. It genuinely helps more people find this content. Let me get back to something I think is really underappreciated in the current conversation about silver. Most of the news coverage of the $86 price is treating it as a geopolitical story. Tensions rise, silver spikes, and yes, that's part of it. But the geopolitical tension is really just the trigger. The gun was already loaded. Let me explain what I mean. The structural demand story for silver has been building for years. Solar panels are now one of the largest consumers of silver in the world. Every photovoltaic cell uses silver paste as a conductor, and the world is installing solar at a pace that was almost unimaginable just 5 years ago. The International Energy Agency has projected that solar installations are going to continue growing at extraordinary rates through this decade and into the next. Every one of those panels needs silver. Not a little silver, meaningful amounts of it per panel at scale. At the same time, electric vehicles are consuming silver in ways the market is still catching up to understand. EVs use silver in their charging systems, their battery management systems, their power electronics, and as EV adoption ramps globally, that demand is only going one direction. Then you add the broader electrification of everything, smart grids, 5G infrastructure, medical devices, AI data centers with their massive power management requirements, and you start to see that industrial silver demand isn't a cycle. It's a structural shift. It's the direction the world is moving, and it's going to need silver to get there. Meanwhile, silver mining has its own set of challenges. Silver is rarely mined as a primary product. About 70 to 75% of all silver mined in the world comes out as a byproduct of mining for other metals: copper, lead, zinc, gold. That means silver supply is largely a function of what other mining industries are doing, not a direct response to silver demand or silver prices. When copper miners slow down for any reason, cost pressures, regulatory issues, declining ore grades, silver supply gets squeezed too, almost as a side effect. This makes silver supply much less responsive to price signals than gold supply, for example. So when you add up all of these factors, the structural industrial demand growth, the supply that's largely outside of silver's own control, the COMEX inventories that have been thinning, and now a geopolitical shock that's awakened institutional interest in hard asset protection, you start to understand why $86 might not be the ceiling. It might be closer to the floor of a new range. Here's a mental framework I want to give you for thinking about silver going forward. There are basically three things you want to watch. The first is the COMEX registered inventory number. This is your physical reality check. If that number keeps declining, it means the physical squeeze thesis is still intact. If it starts recovering meaningfully, it means physical supply is catching up to demand. You can find this data on the CME Group's website. It's public, it's updated regularly, and it's one of the most important data points in the silver market right now. The second thing to watch is the silver lease rate. This is a number that tells you how expensive it is to borrow physical silver in the short-term lending market. When lease rates spike, it means physical silver is scarce and in demand. When they're low and steady, it means physical availability is relatively comfortable. A rising lease rate in the current environment would be a significant signal that the physical market is tightening further. The third thing to watch is the gold-to-silver ratio. This is the number you get when you divide the price of gold by the price of silver. Historically, this ratio has averaged somewhere around 50 to 65 over long periods of time. When it gets very high, say above 80 or 90, it historically has meant silver is undervalued relative to gold. And here's the thing, that ratio, even at $86 silver, is still elevated. It still suggests that silver has historically been priced much higher relative to gold than it currently is. That doesn't mean it will correct immediately, but it does mean the structural argument for silver's relative undervaluation hasn't gone away. Now let me talk about the geopolitical piece more specifically, because I think it's worth understanding why the Iran situation in particular matters for metals markets. Iran is one of the key nodes in the Middle East's geopolitical architecture. When U.S.-Iran tensions are high, several things happen in financial markets simultaneously. Oil supply risk premiums go up, which can push energy costs higher globally. Regional instability concerns rise, which affect trade routes and logistics. And perhaps most importantly, for our purposes, it changes the risk calculus for institutional investors who are deciding how much of their portfolio should be in hard assets versus financial assets. When Trump called Iran's demands unacceptable, he wasn't just making a policy statement. He was changing the probability distribution of possible futures in the minds of every risk manager at every major fund and every corporate treasury around the world. The probability of a peaceful, stable geopolitical environment went down. The probability of an escalatory scenario went up. And assets that perform well in escalatory scenarios, physical hard assets, particularly ones with industrial strategic value, become more attractive. Silver sits right at the intersection of these concerns. It's a hard asset with monetary history. People think of it as money when things get uncertain. But it's also a strategic industrial material that governments and defense establishments care deeply about securing. When both of those qualities become relevant simultaneously, as they are right now, the demand can compound in a way that's very different from a simple financial trade. Think about it this way. Imagine you're the CFO of a major aerospace and defense contractor. You need silver for your production lines. You've been watching the COMEX inventory data. You know the registered stockpiles are thin. You've just watched the Iran deal fall apart, and you're seeing silver jump to $86. You have two choices. You can wait and hope silver comes back down, or you can secure your supply now before it gets harder. Most CFOs in that position are going to choose to secure their supply, and every corporate buyer who makes that choice adds to the demand pressure that keeps the price elevated and pushes those COMEX inventories even lower. This is what I mean when I say the $86 move might just be the beginning of a catch-up. The paper market is catching up to the physical reality. But the physical reality itself continues to evolve, and it's not evolving in a direction that suggests things are getting easier for silver supply. Let me bring this back to what it means for everyday people watching this video, because I don't want this to be just an academic exercise. A lot of the people watching this channel are regular investors, people who have savings, who have retirement accounts, who are trying to figure out how to protect and grow their wealth in a world that feels increasingly uncertain. So let me give you a few practical ways to think about all of this. First, understand that silver is a unique asset class. It's not quite like stocks, not quite like bonds, and not quite like gold. It has this dual personality, part monetary metal, part industrial commodity, that makes it respond to a wider range of economic and geopolitical conditions than most assets. When the economy is booming, industrial demand drives it. When uncertainty rises, safe haven demand adds another layer. When both happen at once, or when a supply shock adds a third layer, that's when you can see the kinds of dramatic moves we're seeing right now. Second, understand the difference between what you can easily access and what's actually driving the price. When most retail investors think about buying silver, they think about coins, ETFs, or mining stocks. All of those are legitimate ways to get exposure to silver prices. But none of them gives you direct access to the physical supply dynamics that are actually driving the current story. An ETF that holds physical silver is closer to the physical market than a futures contract, but it's still not the same as understanding the COMEX dynamics. Knowing the difference helps you understand what risks you're actually taking on and what you're not. Third, and this is important, recognize the risks on the other side. Silver can be extremely volatile. We've seen moves of 30, 40, even 50% in short periods in both directions. A geopolitical situation that suddenly improves, a surprise diplomatic breakthrough, a ceasefire, a negotiated agreement could quickly reverse some of the risk premium that's currently built into the silver price. The supply deficit story is real and structural, but price moves in markets are always a combination of fundamentals and sentiment can shift fast. The story we're watching in silver right now is genuinely complex. It's a collision of long-term structural forces, the green energy transition, the electrification of everything, the growing strategic importance of silver in advanced manufacturing, with short-term geopolitical shocks that are pulling institutional attention toward hard assets. And underneath all of it is a physical supply picture that has been quietly, steadily tightening for years and is now starting to get the attention it probably deserved long ago. The $86 price is a signal. It's the market saying, we have a problem that we haven't fully priced yet. The paper market is finally being forced to acknowledge what the physical market has been telling us for a while. Whether $86 is a waypoint on the way to something higher, or whether it's the peak of this particular move, nobody can tell you with certainty. But the conditions that created the move, the structural deficit, the thin COMEX inventories, the escalating geopolitical uncertainty, the growing industrial demand, none of those have been resolved. The trigger was pulled, the underlying tension is still there. What you do with that information is ultimately your decision, and your decision alone. I'm not here to tell you to buy silver or sell it or do anything specific with your money. What I'm here to do is make sure that when you make your decision, you understand what the real story is, not just the headline, not just the number on a screen, but the physical reality underneath it and the forces that are driving it. Here's the simple version of everything we talked about today. Silver hit $86 because the Iran peace deal collapsed, which removed the diplomatic optimism that was suppressing the paper silver price. But the more important story is that the paper price was suppressed even as the physical silver market was running at a deficit, with COMEX registered inventories at historically low levels. The $86 move Is the paper market catching up to the physical reality? The structural forces driving silver demand, solar, EVs, electronics, defense, are still intact and growing. The supply side is constrained in ways that are unlikely to change quickly. The conditions that created this move haven't been resolved, and in markets, when underlying conditions persist, the story rarely ends at the first chapter. Keep watching those COMEX inventory numbers, keep an eye on the lease rates, and keep paying attention to the diplomatic back and forth on the Iran situation, because in today's market, geopolitics isn't a side story, it's front and center. I'll be covering all of this as it develops, so make sure you're subscribed so you don't miss the next update. And if you learned something today, share this with someone who's been trying to make sense of what's happening in the metals market right now. Thanks for watching. I'm John Smith, and I'll see you in the next one.